Hey traders, and welcome to another episode of Smart Risk. One of the most challenging steps in trading is setting up entry points in the market, especially for smart money traders. It can be particularly challenging because many smart money traders are unsure whether to use fair value gaps or order blocks to execute trades in the market. In this advanced episode, we're going to clarify these doubts and explain the scenarios and price actions where each method shines. We will delve into the key points and criteria that you need to consider in your trading strategy to choose the best possible entry method in the market for executing trades, ultimately leading to more winning trades. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So, let's get started. As you know, guys, order blocks and fair value gaps are two areas that smart money traders use as entry points to execute their positions in the market. However, there is often confusion among traders about which of these areas offers a higher probability and is more likely to be respected by the price. Here we have an example where the price hits the higher time frame order block but not the lower time frame order block. This highlights a key point that needs to be considered. If the price frequently misses your entry, it suggests too much refinement is taking place. Now let's take a closer look at this example. We see that the price was in a downtrend until price reversed its direction, pushed higher, and after taking out the inducement level, eventually created a change of character by breaking and closing above this major high. With the emergence of a change in character indicating an upcoming bullish trend, we look to enter the market by opening a long position. Now, where do we look to go long on this chart? Firstly, we need to identify the discount zone, which includes these higher and lower time frame order blocks inside it. If you truly wanted to enter the trade and place a buy position based on the higher time frame's order block, you could have simply entered a buy limit order at the highest point of the higher time frame's order block, with the lowest point of the order block area as your stop loss. This approach would have allowed you to enter the market, and the price would likely have moved upward after activating your buy limit order. However, it's important to note that setting such an entry would result in a very large stop loss, leading to a small reward-to-risk ratio in every trade. This exposes you to higher potential losses if the trade moves against you. If you aim to have a tighter stop loss and a higher reward-to-risk ratio, you need to refine your entry area. Many traders often focus on the extreme lower time frame's order block at the bottom, as seen in most analyses. This approach may seem perfect because it offers a very tight stop loss and already provides a high reward-to-risk ratio. However, if the extreme lower time frame's order block were hit every single time, the market would appear as a zigzag pattern everywhere, which is not realistic because price does not often make such deep retracements. So, what is the solution for this? Many times, order blocks are not respected, but what is often seen in scenarios like this is that the fair value gap is respected quite often, especially in lower time frames. Now let's bring everything together and consider what price is more likely to do when it reaches the order blocks and fair value gaps under various circumstances. So in the higher time frames like 1 hour or 4 hour time frame, the price is more likely to respect the order blocks rather than the fair value gaps. On the other hand, in the lower time frames, price is more likely to respect the fair value gaps rather than order blocks located at the extreme areas. Before we continue, if you're curious about how we stay updated on financial news and fundamental analysis, well, we rely on Fastbull, one of the best trading websites with various useful trading tools. This site provides one of the most accurate and detailed economic calendar, a tool we use every day before starting our technical analysis. 24/7 economic live streaming also allows us to stay informed about the latest trading world's news and fundamental analysis. So if you want to benefit from multiple trading tools that can significantly improve your trading, make sure to check the link in the description. So let's imagine that price creates a structure like this one on the lower time frame. As we mentioned before, on the lower time frame like 15-minute or 5-minute, the price is more likely to respect the fair value gap that is formed below or above the order blocks, and get reversed from it before mitigating the lower time frame's order block, which is located at the extreme. The idea of using lower time frame fair value gaps to determine entry points can be quite effective. Setting up entries based on fair value gaps often results in a higher hit rate compared to extreme order blocks. However, When using fair value gaps to enter the market in a bullish scenario, we typically place our limit order at the highest point of the fair value gap, and our stop loss should be positioned below the extreme order block. This approach results in a wider stop loss, which directly reduces the reward-to-risk ratio of the trade. Setting a tighter stop loss just below the lowest point of the fair value gaps can be an option. However, this approach does expose trades to higher risk. The extreme order block situated below the fair value gap area might still influence price action, leading to a downside movement that triggers the stop loss. Therefore, while a tighter stop loss may seem appealing, it's crucial to carefully consider the potential risks involved before implementing this strategy. As mentioned earlier, on higher time frames, we primarily focus on order blocks for entries, even though traders can still stick to solely relying on order blocks on lower time frames. However, it's essential to consider that following this approach may cause traders to miss out on numerous trading opportunities. Now, we have already discussed the scenarios that we might encounter in the market where the price respects order blocks, fair value gaps, or both. However, in the market, we might encounter another scenario where the price does not respect any of the order blocks and fair value gaps. Let's delve into this specific scenario and see what the main reason behind it is. Most probably, you found yourself in a situation where you identified a perfect trading setup and a great opportunity to enter the market once all the criteria of your trading strategy are met. You've also identified a perfect trade setup, and you were eagerly waiting for the price to fulfill your pending order, which was placed on the fair value gap or order block you identified earlier. You were getting excited about having a perfect trade, but somehow the price continued in the direction you were about to open positions aligned with, without activating your pending orders placed on the extreme of the fair value gap or the order block. Eventually, you missed the trade. The main reason why the price is likely to behave in this manner is that it creates a significant inefficiency when attempting to retrace back to the fair value gap or order block located at the extreme. In such a scenario, as the price creates a substantial inefficiency on its way towards the extreme order block or fair value gap, it struggles to resist the massive liquidity voids behind it. Therefore, it experiences a pause to fill the liquidity voids caused by the inefficiency. However, as the price retraces back and aligns with its dominant direction, it fails to push in the opposite direction to activate pending orders located at the order block or extreme fair value gap. This is because when the price aligns with its dominant and primary direction, it absorbs the significant momentum from the orders executed by traders who anticipate that the price's retracement phase is over, and it's time for the price to continue in its primary direction. These series of actions propel the market in the price's dominant direction without activating limit orders at the order blocks and fair value gaps. If we examine this trade example in the euro-dollar pair, we see that the price is in a downtrend and has already established a bearish break of structure by breaking and closing below the most recent major low. As illustrated, there is an order block at the extreme, and we can also identify a fair value gap just beneath the order block. We can take advantage of these areas as entry points. As we analyze the chart, we can see that the price has begun to retrace back down toward our identified order block and fair value gap at the extreme. However, the price changes its direction before reaching these zones. The main reason for this change in direction lies in the inefficiency that has been formed within the retracement wave. Let's consider a general trading example where we bring together various concepts discussed previously in this episode. But before continues, you're an experienced trader looking forward to getting funded, register with our trusted prop firm, Funded Next. Funded Next is one of the top-rated prop firms on Trustpilot that provides one of the lowest spreads and commissions in the industry. They offer a variety of plans for traders with unique services, including a 15% profit share from the challenge phase and a 10% profit target with no time limit. If you're seeking a prop firm that genuinely supports your trading journey and provides financial needs, register with the link in the description to get a 10% discount with our exclusive code and experience their exceptional services for yourself. Here we have the euro-dollar 15-minute time frame displayed on the screen. We see that the price moved lower and also mitigated the 1-hour time frame's demand area, which is situated below the liquidity pool formed by the equal lows. Upon zooming into that area, we noticed that the higher time frame's demand zone was respected. Following the mitigation of the higher timeframe's demand, the price pushed to the upside, and after taking out the inducement level, broke out and closed above the most recent major high, thus creating a valid change of character. In the next step, we are exploring potential entry points to go long. The first entry opportunity here would have been at this order block, situated at the extreme. Let's say that we miss this entry. Where would you look to enter long? We see that the price has made another bullish movement to the upside, and has also created a bullish breakout of structure, confirming that the price has changed its direction to bullish. Now, as we start to look for an entry, we have two options to consider. The usual approach, used by many traders, is to use the order blocks at the extreme side. Here, we have an imbalance that needs to be filled, and this order block is situated under the fair value gap. Our entry strategy would be as follows. We wait for the price to retrace back down to activate our buy limit order, which has been placed at the highest point of the order block area, and then push to the upside. In the second option, we are considering entering the market from the fair value gap area. This approach is commonly seen in lower time frames. When entering from the fair value gap, it's important to consider a key point. You could place your entry at the highest point of the fair value gap and set your stop loss just below the fair value gap area. While this strategy can be effective at times, it's important to note that your stop loss will be very tight. Additionally, since we have an unmitigated order block at the extreme, there is a possibility that the price could push downward to fill it. So, I recommend keeping your stop loss a bit wider by placing it beneath the order block. The whole point of this type of entry is to reduce the possibility of missing a trade, although it does reduce the reward-to-risk ratio. Now let's consider what would have happened with both of the trades. For the first option, if we had waited for that order block, this is what would have happened. Let's say that we already had our take profit set at this high. It's clear that we would not have entered this trade since the price couldn't activate our buy limit order. If we had entered from the fair value gap, our buy limit order would have been activated, and our take profit would have been hit by the price. We can see that the trade played out without pulling back to the extreme order block. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.